Good morning and welcome to Real Estate Economics webinar series. I'm John Mulville, Vice President of Consulting here at Real Estate Economics, and I'll be leading today's discussion of the Denver, Colorado MSA. Here's our overview for today's webinar. We're going to take a look at a historical perspective. This area has some fairly unique history that's occurred in the past few years. Where are we now? A look at employment, obviously very important in today's climate. We'll take a look at our 5-year forecasts and draw some summary and make a conclusion for today's webinar. First, let's start with the historical overview. This is a distribution of housing transactions for the single month February 2007. Now I go back to 2007 here because if you recall, this is prior to the recession. This is prior to the Lehman Brothers collapse. The national economy at this point in time is performing fairly well. Credit is at least plentiful. Jobs are plentiful. Unemployment's relatively low. And yet this market is suffering through nearly 30% of all transactions are foreclosures. 13% are foreclosure sales. At the same time, we have these robust foreclosure numbers. New home sales also make up 20% of the market activity. This is pretty unusual profile for almost any MSA we look at regionally to have high numbers of foreclosures and high numbers of new home sales at the same time. Clearly, subprime lending has had a severe impact in the Denver MSA as early as 2007. Let's come forward a full year, and the distress is actually lower in February 2008 than it is in 2007, although still severe. The combined foreclosure and foreclosure sales market share is 36%. New home sales now have dropped into the single digits, and conventional resales are taking about 56% of the total market. But you can see a paradigm or a character change, if you will, from 2007 to 2008. Already this market is felt quite a bit of distress, and we are still pre-Lehman Brothers, pre-official start of the recession. Let's come forward one more year. New home sales continue to drop. The distressed part of the market is still pretty significant at about 36%, but we've had a huge contraction in new home sales, and now this area looks to be a little bit more in sync with the national trends. Subprime is clearly an issue by 2009. We're clearly in a recession at this point. Lehman Brothers is barely in the rearview mirror, having taken place in September 2008, but the repercussions of the financial crisis and the credit crisis are very widespread at this point in time. Come forward one more year, and the character looks pretty consistent from 2009 to 2010. Still over 30% of the transactions are distressed. Conventional resales are picking up a little bit here, a little too soon in our view to start calling it a increase in short sales and fewer distress sales. That hasn't really happened at this point, but we still have quite a few conventional resales, not many new home sales. New home market shares dropped all the way to 4%. Let's come forward one more year. We're now 2011, single month, February 2011. New home sales only 5%, and the distress is as high as it's been at any point, about 34% for this particular month. Again, conventional resales shown in the blue dots still clearly dominating. At this point in time, we're starting to see more short sales in that number. Lenders are finding out that their recoveries are higher through a short sale than through a foreclosure sale, and so short sales are picking up market share at this point. Let's come to the most recent data, February 2012, and the market looks not too different than it was the previous year. We've got a general stability in terms of overall percentages. Resales, new home sales at 5%, foreclosures and foreclosure sales just a little bit over 30%. So what's happened in this 6-year time period in terms of overall values? You can see 2007, the average value is about 285,000. That number degraded very significantly through 08 and 09, but now in the past 3 years, that's 2010, 2011, 2012, value ratios are quite stable, and even the average prices are only varying a couple of $1,000s year over year over year in this particular market. You can see the general price stability at the bottom of this chart. We've got average sold price for the last 3 years. Very notably here, the condo market has been relatively stable. 183,000 2 years ago, 179 last year, and 180 in the current month, February 2012. Many markets we've seen, the condo market has really led the prices down. Condos have generally taken more traffic, greater exposure, more discounts to sell. Demand has clearly migrated back to single-family homes in most markets, but this area has got a pretty steady condo market. The same can be said at the bottom of the table again for the single-family homes. Those prices are quite stable from 2010 to 2011 to 2012, and at the bottom right, the value ratios, price per square foot data, is also holding up and looks pretty stable on a year-over-year basis now for 3 years running in this particular MSA. We've traditionally seen in this market about a 20% market share to condos. That hasn't really changed much. Again, showing a pretty steady trend for attached units in terms of their ability to capture market share in the Denver MSA. Let's look at how the sales have distributed. Over the last couple of years, new home sales consistently low in the less than 300 or in about the 300 range, and foreclosures and foreclosure sales, again, those numbers are just staying steady year after year. Across the nation, we tend to see quite a bit of variety or flexibility in terms of the foreclosure sale numbers. There are many markets where it's lender or asset holder performance tends to vary widely. Some markets, the lenders are quite good at dealing with their distressed assets. Other markets, they're not. So we see normally quite a bit of flexibility and variance. That's really not the case in this MSA. Overall, you can see at the bottom, we've summed up the total for the two distress categories. That's owner back to lender, and foreclosure sale, lender out to new third-party owner. And those numbers are still in the low 30s. So we're going to present some employment data, and most of the numbers on employment and that sort of thing look pretty good in this area. So it's almost a little bit of a surprise that distress remains pretty high here. We're still working through a backlog of distressed inventory. This is going to take some time. We recognize this. We would really start to expect, given the employment profile in this location, to start to see some of this distress burn off a little bit faster pace and gradually start to clean itself up. And we'll talk to some of the reasons why that is and some of the conditions in upcoming slides. This particular graph shows how the sales distribute by price range, and you can see what happened here during the disruption and the recession several years ago is there's a tremendous migration into the lower price points. Sales come out of all the higher price points and really take a shift to the left into the much lower price points. We've started to see a little bit of a reversal here. There's more activity in the $300,000 to $400,000 price range, 5 to 6, 6 to 8, and so forth. This is consistent with the market reaction in many tourist destinations in many markets. You know, this area has Aspen in the data, that sort of thing. People are finding their way back into these premium markets, having been priced out for many years. If people have good incomes and they've always wanted to live in some of these high value areas, they're taking the leap in many cases. We've seen this in Florida, we've seen this in Southern California, Northern California, and some of the other high value markets where people are again starting to acquire some homes in these premium markets. Let's look at employment in this particular market. You can see by the super sector basis, this area is doing quite well at this point. It's been very interesting. This is an area that has benefited significantly from quantitative easing. This area has a good high-tech base. There's a lot of information. This area did well during the dot-com boom. When quantitative easing comes along, a lot of capital tends to flow into capital-intensive industries, which really means the high-tech sector. So the high-tech sector in this market has performed well for a couple of years. It degraded very quickly when the recession came along. That's sort of typical of that industry group. But it's also recovered very quickly and now has been adding jobs for a couple of years. And one of the things we should really call out in this particular area, natural resources, mining and construction. This area has boomed, whether it's popular or not, has done quite well through unconventional drilling, fracking. There's large natural gas plays, a lot of land leases for drilling purposes have taken place in this particular area, and so the employment has really picked up in related industries. This is a good headquarters area for those sorts of companies, and really one of the larger cities. Denver is really one of the larger cities that's close to many of these unconventional natural gas and other resources that they've been drilling for through fracking. Since we took a little bit of a historical look at the transactions, I'd like to go and do the same thing here in terms of employment. So this is the 2011 to 2012 numbers. Let's go back a year and look at it. The same wasn't the case a year ago. Mining and construction wasn't doing quite as well a year ago, so some of that activity has been fairly recent, but the rest of the super sectors looked pretty good from 2010 to 2011. This market was really showing some signs of job growth fairly early, especially compared to the nation and to many other MSAs. But let's go back one more year and you can see where this area really was suffering in 08 and 09. At this point in time, almost all the sectors are getting hit pretty hard. This area has a good education sector, higher learning, colleges, that sort of thing. That was holding up, but the rest of the super sectors were very, very soft in 09 to 2010. You can see that going back historically here. What we would point out is look at the 2002-2003 time frame. That's the dot-com meltdown, if you will. This area is quite sensitive to high-tech employment, and so that same sort of pattern repeated here in 2009 and 2010. It's a sharp drop-off in employment, very steep, very severe, quite pronounced, but it was also fairly short in duration. We have many markets across the country where some of these job losses have lagged and dragged on and on and on. That really hasn't been the case here. The downtrend was quite serious, quite severe, very pronounced, but it also rebounded very quickly. 2011 was a good year for job growth in this area. Again, unlike many parts of the country, this area rebounded quickly and has been strengthening through 2011 and 2012 with still better numbers in our forecast for 2013. Let's take a look at our 5-year forecast for this MSA. We spoke just briefly there about employment. You can see the annualized unemployment numbers here. Colorado is doing better than the nation as a whole. Denver is doing better than the nation as a whole. The recovery has been more robust in this area. The numbers were never as high as experienced in the nation or some of the other western states, with California and Nevada really having the poorest employment results in the nation. This is a great performance compared to some of the other western areas. If you look back through history, this area has tended to have very low unemployment, and at the same time it's picked up population. So the business climate's considered pretty good here. Colorado ranks quite high in most measures of business competitiveness and has managed to create jobs on a pretty consistent basis year over year for the past couple of decades. Quick look at mortgage interest rates here. Everyone knows that the Federal Reserve has essentially promised to keep rates low through 2013, through 2014. We've got a gradual increase in mortgage interest rates building into our forecasts over the next few years. For quite some time, we were very concerned about the rate picture going forward, that when quantitative easing ended, we would suddenly have a significant adjustment that could prove to be quite shocking. I think some of that is starting to wear off a little bit. It looks like internationally, the Chinese economy is pretty weak. The Europeans are going into a recession. India is starting to sort of roll over in terms of its PMI data, that sort of thing. So the international economies are sufficiently weak that we doubt there'll be that much motivation, that much pressure for U.S. interest rates to rise quickly and steeply. So we've got a little bit of a moderate uptick in the rates here, but it doesn't appear like it's going to be nearly as severe as we might have thought 6 months ago or a year or two ago. Let's look at overall price trends in this market. You can see this is a market that enjoyed quite a bit of price appreciation from the 90s right up through the dot-com era when this area went flat. Pretty significant drawdown, as we've talked to, in 2008. But really, that downtrend started in 2007, as we mentioned earlier, leading really most MSAs in the nation by having some negative price activity in 2007, before the recession, before Lehman Brothers. We got a little bit of a bounce in 09 and 2010, and now we're almost flat, which is really mirrored the price data we showed earlier, with both condos and single families being, at very stable, near zero appreciation. Now in our forecast, we're starting to pick up some minor appreciation in 2012. That's only 0.6%, really meaningless in our view. Going to bounce around a little bit from month to month and be somewhat dependent on the percentage share of foreclosures compared to conventional resales in the data. But in the later years of the forecast, we're starting to pick up a little bit more appreciation. We would say that this market was severely overcorrected in terms of price, and so we are going to start recapturing some of that price in the next few years with pretty steady appreciation going out to 2016 and 2017. Here's the overall trends in terms of values. You can see the peak 2006 was about 249, almost 250,000. That degraded by 2008 to about 216, and we've been slowly building back since then. By 2015, we should be reaching all-time highs again, 252, and getting some appreciation in those outer years. And we'll talk to that appreciation in some coming slides, because there are some issues that are going to really impact those numbers as we go forward. Here we look at trends in valuation going back to 1990. The green line is the supportable median home price. Now, how do we know what that is? Well, we know what household income is in these markets, we know what interest rates are, and we know what percentage of the household income people will apply to home ownership. So we can, at any point in time, calculate a supportable median home price. The blue line is the historical price. So what tends to happen in this market and almost all others is that when employment conditions are good, the historical price goes above or starts to rise as people buy more homes and there's optimism, and the supply tends to grow very slowly. So when jobs are good and wages are growing and people are confident, prices rise and they get a little bit extended above the supportable numbers, and that can continue for years. If you look at this particular market, the historical median home price crossed over the supportable numbers way back in 99 and stayed above, significantly above, all the way through about 2007 or 2008. Now, that disconnect is not nearly as large in this market as it is in many of the boom-bust markets, Vegas, Phoenix, most parts of Southern California. So this area stayed generally well correlated. Now come out to the current point in time, say 2012, and the green line and the blue line are widely separated. That's the measurement of undervaluation that exists in this particular market. I'd like to call just one more very important point on this particular chart. We've had declining interest rates in the U.S. since about the early 1980s. So that whole time, lower and lower rates have provided a good tailwind, if you will, for home values in the U.S. and in this market. People have gradually been able to get more house with the same income because rates have been going down. Well, you recall earlier we talked about rates going higher. You can see that in the decline in the green line in the forecast period. As rates go up, it's going to take more and more money to afford that same house. And what that really does is puts a lid on house price appreciation over the long term. If we get rates going up, that will keep prices generally stable. So even though we have good employment numbers in this particular market area, you didn't see huge appreciation. That reversal in rates will be working against us for a few years here. Let's look at forecast housing demand and supply patterns. This is construction measured by building permits in this area. You can see this is a market that has averaged over 30,000 permits from 98 really all the way through about 2001 when the dot-com, and 2002 when the dot-com took the wind out of the sails a little bit, and now we are at historical lows. The only time we've been lower than the 2009 through 2013, 2014 time period is way back in 1990 when the size of this economy was much smaller. So we are producing very few homes in this area for years and years. That's ultimately going to help us deal with the overhang of distressed inventory. There isn't that much new home supply coming in. As you can see, this area does have some multifamily permits, and those permits are expected to grow pretty steadily in the forecast period. Most of the multifamily operators we talk to are only interested in the core markets, the best markets. They will pay what has to be paid in the strong demand in those core areas where the jobs are good, and we see very little appetite in going out to the suburban markets and the Class B or lower markets at this point in time. I think that apartment capital, construction capital, has learned its lesson and will be much more cautious in this next cycle. Let's look at supply and demand. This area, as in most areas, supply is something that doesn't grow very fast. Acquiring land, gaining entitlements, getting designing plans, getting financing, that sort of thing takes time. So supply grows generally slowly and doesn't advance too quickly. By comparison, demand is much more volatile when employment ramps up, particularly such things as high-tech employment. You can see in 2001 and 2002, demand for housing goes across the blue line and accelerates away from the blue line. There's really only one way for that excess demand to manifest itself, and that's through higher prices. So prices tend to run up in these periods. Just as quickly, when employment weakens, the demand draws down. And when the demand is below the supply, that's when you get a buyer's market. That's when there's price pressure on homes across the region. As you can see, there's been quite a bit less demand for housing than supply since about 2008. We saw that in the foreclosure activity. And it's just about to cross back over, with demand exceeding supply in 2013, 2014, and in the outer years of the forecast. So this market is just about to come into equilibrium. We saw that in a fairly steady pricing relationship. Incomes are good, employment is good, and so this area has really suffered through its downdraft and is once again generally steady. Let's look at the overall conditions here. The market has been characterized from 2007 to about 2013 on the left-hand side of this particular table as overbuilt. What's really happened here is when the employment weakens, it turns that there's really just too much housing stock. The size of the housing stock is really too big in comparison to the number of people employed, and that results in an overbuilt characterization of the market. when job growth resumes, 2014, 2015, 2016, and the supply doesn't grow very fast, those numbers will reverse and there'll be more than sufficient deployment for the size of the housing stock, and the market will be characterized as underbuilt. On the right-hand side, we see the overvalue-undervalue equation. Homes have been tremendously undervalued, severely undervalued in this market from 2008 right through about 2015, when that will reverse and again become overvalued on the relationship between household income and overall home prices. Now in the red circle, I talked a couple of moments ago about interest rates and how those rates would be going higher in the forecast period, and that will ultimately lead to you'll have to spend more of your income to own that house than you would have when rates are lower. So this really starts to manifest itself in 2012, 2013, and in the outer years. So all these years, the past 30 years, interest rates have been a tailwind for the market. In the coming years, interest rates are going to be a headwind for the market, and it's going to take greater and greater amounts of income to support that same house price. So when those mortgage rates are growing much more quickly than income, that puts pressure on this equilibrium home price that we've calculated, and really will gradually put a lid on price appreciation, put a ceiling on price appreciation when people just can't afford to spend any more, carve out any more of their household income for the house. That'll ultimately put a lid on house price appreciation, not only here, but in all MSAs nationally. So really, what's the summary? What's taken place in this market, and what are the points that we should take with us today? This market was hit hard by subprime. We talked about this before the recession even took place. This market had severe distress. We could see that from the foreclosure data going way back to 2007. The recession was much shorter here. It was very pronounced. It was quite steep. It was a shock, a jolt, if you will, but it didn't last as long as it has in many MSAs nationally. The quick down spike was followed quite rapidly by improvement in employment, improvement in incomes, improvement in wages. That's part of the political leadership here. They haven't taken anti-competitive measures. We've got many states across the country that are suffering in terms of their competitive business environment. This isn't one of them. Colorado tends to be ranked quite high in most measures of competitiveness, and ultimately employers around the nation are looking to locate in places where the business environment is friendly. At this point in time, Colorado and Denver, unemployment is lower than the national, and it's picking up steam better. It's improving at a faster rate and starting to separate itself in terms of the total employment numbers. As I mentioned earlier, fracking's led a recovery in mining and natural resources, and this high-tech employment base has definitely benefited from quantitative easing. The undervaluation remains significant in this area. It's not cured yet and will be met by a couple of years of moderate price appreciation, really starting in 2012, picking up steam in 2013, and really going out through our 5-year forecast period. One thing we've observed in this market, high percentage of cash sales, high percentage of absentee owners. That tells us investors are active in this area. People are looking for places to invest in rental homes, own those homes for a few years in most cases, and ultimately sell them out a couple of years out when the prices have appreciated somewhat. And very low permits. We showed how low the permits were, and that will allow the distressed inventory to be absorbed and ultimately bring this whole problem with distressed assets back into focus and back into control. Here's an overview of our products. Many of you are familiar with our residential economic report, our housing profiles, economic permits, demographics. In our consulting group, we do a lot of site-specific feasibility work, land optimization, retainer services across most of the West, Hawaii, Arizona, Nevada, California, particularly strong areas of expertise. Here's our group. Many of you know Mark. That's me, John, and Sandy and Judy are in our sales and support group. Please, if you're a current subscriber, make use of our group here. We are the single most active user of our own product, so there's a lot of things you can do with it that we'd be happy to share with you, some of the finer points and some of the higher expertise things where you can really get maximum bang for your buck on the product and on our services. Thank you for joining us today. We've got different market areas scheduled for the next few weeks. We should be talking about Dallas in coming weeks, West Palm Beach, Charlotte, Portland, and Seattle over the next month or 6 weeks. So please join us for our upcoming webinars. And you can always visit us at www.realestateeconomics.com. Thank you for joining us today. Please call me if you have any questions or opinions. We'd love to hear from you. Thank you very much.